The US mortgage market is collapsing right before our eyes, with mortgage lenders going bankrupt just like they did in 2008. First Guaranty Mortgage Corporation, a large lender out of Dallas who's been around for over 30 years, they just filed for Chapter 11 bankruptcy this week. And this is going to be the first of many mortgage companies to declare bankruptcy and go out of business, a reality which is going to cause the 2022 housing crash to be even worse than anticipated. Because over the last 2 years, everyone, nearly 70% of all the mortgages originated in America were made by what's called non-bank lenders. What that means is that a majority of the capital flowing into the US housing market comes from companies that are loosely or lightly regulated and that have a high probability of going out of business in an economic downturn. And what's especially concerning is that this share of non-bank lenders at 68% in 2020 was even higher than it was in 06-07 at the peak of the last housing bubble. And then you all can see what happened. There was a major crash in non-bank lender mortgage origination, which caused the housing crash to get worse. I believe we're about to see something very similar play out in 2022. And before getting more into the details on this, everyone, I want to explain why this is so important, why you need to care about the fact that mortgage lenders are going out of business. And it's simple. If these lenders go out of business, it's going to deprive the housing market of loans and mortgages that are needed to sustain home sales and home prices. And that as more mortgage companies declare bankruptcy, there's going to be fewer and fewer available loans in the housing market, which is of course going to cause the housing market to crash further. And to really understand this, we need to go back to 2007, 2008 during the last housing crash, because people don't really understand why the housing market crashed so much last time around. They make the mistake of thinking that it was all about foreclosures, but what it was really about last time was that banks and mortgage lenders stopped making loans. You can see they went from making 6.5 million home purchase loans in the middle of 06 to down to 2.5 million in 2011. And so if you were a home buyer back in 2010 and 2011 and you tried to go buy a home and get a mortgage to do it, there's a good chance that you would get rejected or that there wouldn't be a lender around to give you that mortgage. There was no mortgage capital available to sustain the market, and I fear we are entering a similar situation here in the second half of 2022. There is massive systemic risk inherent in these non-bank lenders. They made 68% of all mortgages in 2020. The US housing market cannot function without these non-bank lenders, yet so many of them are in a precarious financial position. Take, for instance, LoanDepot. They are the fourth largest mortgage originator in America, having made $137 billion of loans in 2021. That was more than JP Morgan. That was more than Bank of America. What's scary about this is that LoanDepot is in very poor financial condition. You can see their stock price right now is trading at $1.50 a share. It's collapsed by 88% over the last year, and even worse, LoanDepot lost $100 million in the first quarter of 2022. And so this is a messed up situation, everyone. The fourth largest mortgage lender in America loses money and is being treated by Wall Street investors as if it is going to go out of business. So now we need to ask, what happens if LoanDepot does go out of business, just like First Guaranty Mortgage Corporation did? Well, folks, that would leave a massive gaping hole in the mortgage origination market in America, which would mean there would be fewer loans and fewer mortgages available for you all to go out and purchase a home. That would likely cause a contagion effect that would cause other non-bank lenders to go out of business, and thus would make potentially the crash in mortgage origination as bad as it was back in the late 2000s. And folks, it's not just me saying this. Back in 2019, regulators identified non-bank mortgage firms as potential risks to the US financial system. In particular, the Financial Stability and Oversight Council said, pay attention to this, folks, that non-bank lenders have relatively few resources to absorb economic shocks, and that strains in one non-bank lender could cause counterparties to, get this, folks, question the viability of others, aka a contagion effect. Meanwhile, another report from 2020 said this, that there's a risk of massive non-bank failures. They could be cut off from short-term funding, unable to meet their obligations, and face bankruptcy, just like what happened during the subprime crisis when half of all non-bank lenders collapsed. And no one is paying attention to this risk right now. There's this delusion currently in the housing market that somehow, because there's not as many bad subprime loans being made this time compared to 08, that the mortgage market is healthy and that we're not going to see a housing crash. Folks, that is so wrong. There is even more risk today than there was 15 years ago in terms of banks and their ability to fund loans into the housing market. And the reason that there's a greater risk has everything to do with the Federal Reserve. Starting in 2008, during the last crash, the Fed started buying mortgages. They started buying in 2008, and by the beginning of this year, they owned $2.7 trillion in mortgages and mortgage-backed securities. That's 25% of the entire mortgage market that the Fed owns, which has basically been a subsidy to the mortgage market. It's pushed mortgage and interest rates down. It's made banks more willing to lend. But the problem today is that the Fed is no longer buying these mortgages, and now they're actually going to wind down their mortgage portfolio and could even sell some of these mortgages into the market. And this lack of Fed support in the mortgage market is one of the reasons mortgage rates are spiking so much, and one of the reasons why First Guaranty Mortgage Corporation, the mortgage lender out of Dallas, went bankrupt. Their management concluded they could no longer continue operations without a significant injection of new liquidity. However, despite their best efforts, they were unable to obtain additional equity capital or financing. And folks, that's a big statement right there. That when First Guaranty Mortgage Corporation went to raise more money to help them continue operations, they weren't able to do it, which suggests that this is not an isolated problem and that other non-bank lenders will be declaring bankruptcy in the coming months. Now, what's crazy is that these issues in the mortgage market are happening just as Wall Street real estate investors are starting to sell out of the housing market because Starwood Capital, one of the largest single-family home owners in America, is looking to unload a portion of their portfolio for $1 billion. Now, this is interesting, right? Because only 3 or 4 months ago, we were sold a narrative that Wall Street investors were just going to keep buying homes in the housing market and that they were going to try to take over the housing market. Yet now we have one of the biggest Wall Street landlords looking to unload a portion of their portfolio. This is, of course, something I predicted on this channel 3 to 4 months ago. We're going to see in 2022 investors sell a lot of these homes. Now that we're in a rising interest and mortgage rate environment, this is going to put downward pressure on the housing market, and many investors are going to drop out of the market. Now that we actually have one of the biggest Wall Street landlords selling, this is going to send a signal to all the other corporate landlords that it's time to get out of the market. That's happening just as we're seeing non-bank mortgage lenders start to declare bankruptcy. I mean, folks, just zoom out for a second. Even if you're someone who's more bullish on the housing market and you think like it's not going to crash, these two trends occurring simultaneously with each other to go along with like a massive spike in inventory that's occurring on the housing market right now suggests that we are only in the beginning of this housing crash and that it's going to get worse and it's going to be as bad as 2008, everyone. Like the more and more I look at this data and the more and more I see what the players in the housing market doing, I'm becoming convinced that the value declines are going to be comparable to 2008. Maybe it's not going to be through 10 million foreclosures, but it's going to be through buyers dropping out of the market. It's going to be through investors selling. It's going to be through mortgage lenders going out of business. And the end result that you all need to prepare yourself for is this, is that it's going to be very hard to get a mortgage going forward over the next 1 to 2 years. That is my prediction. As we see these mortgage lenders go out of business and as we see home prices go down, the remaining mortgage lenders are going to be very hesitant to make loans. They're going to want big fat down payments. They're going to want good FICO scores. So if you are planning on buying a house over the next 1 to 2 years to take advantage of the crash, you should be preparing to put down 30 to 35% down if you want to truly take advantage of the housing crash that's going to occur. For some people, that might be easy. For other people, that might be hard. But I think everyone would benefit from saving more money and getting their cash position stronger to take advantage of this crash that has already started to occur. Now, one last thing, everyone, I need to talk about a final point that has me even more concerned about the future of the mortgage market in America. And that's that in addition to non-bank lenders going out of business like First Mortgage Guaranty Corporation and potentially LoanDepot in the future, I have a fear that big commercial banks who make mortgages like JP Morgan and Wells Fargo are also going to drop out of the market and make the mortgage crash even worse. That's because CEOs for both companies, who are number 3 and number 5 in mortgage origination respectively, have said that they plan to reduce their mortgage volume going forward. In particular, Jamie Dimon says that JP Morgan is shying away from servicing federal FHA loans because he thinks delinquencies are going to hit 5 to 10% in a downturn. Additionally, the CEO of Wells Fargo, Charlie Scharf, said that the bank's embattled mortgage business is going to have a smaller footprint in the future and suggested that criticism of their home lending practices by the government are to blame. The problem that's resulting is that big commercial commercial banks like JP Morgan and Wells Fargo now don't want to make as many loans or mortgages into the market, and thus the non-bank lenders have to fill the gap. And I want to be clear, I'm not saying the non-bank lenders are making bad loans. I think for the most part, they probably make decent loans. I'm saying that the non-bank lenders are not financially stable. They're not backed by the FDIC. They're not backed by the Fed. And as a result, they can go out of business and leave the US mortgage market in a lurch, which is a big problem when the big commercial banks like JP Morgan and Wells Fargo are now wanting to reduce their exposure to the housing market